Welcome to Finance with Shahrukh. On this channel, we talk about finance and the economy in simple terms. Let's begin. Let me ask you something. If you opened your crypto app right now and the sell button didn't work, would you still believe you own your Bitcoin? Because right now, Bitcoin is crashing, prices are falling fast, panic is spreading faster. And at the exact moment people are trying to get out, exchanges are freezing up, apps stop loading, withdrawals get paused, orders get stuck. And when your money is moving down, but you can't move it yourself, that's when fear turns into chaos. Today, we're breaking down exactly why Bitcoin is crashing, why exchanges freeze during crashes, what's really happening behind the scenes, and what this means for you. No hype, no drama, just the real mechanics of how this system works. It processes data in stages: input, analysis, and then output. Why is Bitcoin crashing? Seriously, why? First, let's define what crashing actually means. A crash is not a normal pullback. A crash is when price drops rapidly in a short period of time, often 10%, 20%, sometimes even more within days. So what causes it? What if I told you Bitcoin doesn't crash because people panic? It crashes because of math, because of leverage. And when that leverage explodes, the market doesn't fall, it collapses. It crashes because of math, because of leverage. And when that leverage explodes, the market doesn't fall, it collapses. In crypto, most traders don't just buy Bitcoin. They borrow money to bet bigger. This is called leverage. Let's break it down. If you have $1,000 and you use 10x leverage, you're now controlling $10,000 worth of Bitcoin. Sounds powerful, right? But here's the catch. You didn't actually own $10,000. You borrowed $9,000 from the exchange. And exchanges like Binance, Bybit, and OKX don't play games. If the market moves against you, even a little, your position gets liquidated. Liquidation means the exchange automatically sells your Bitcoin to recover the money you borrowed. No warning, no emotion, no second chance. This is a world of controlled power. Now imagine this happening, not to one trader, but to thousands at the same time. Liquidation cascade. Let's say Bitcoin drops just 3%. That small drop triggers liquidations for over-leveraged traders. Those forced sales push the price down further. Now the price drops 5%. More positions hit their liquidation price, and more forced selling. Now it's down 8%, more liquidations. This is called a liquidation cascade, a chain reaction. Forced selling creates lower prices. Lower prices trigger more forced selling, and suddenly, what started as a small dip turns into a full-blown crash. The markets are reacting with panic, and the fallout is just beginning. It's not just fear. It's not just bad news. It's leverage. It's automated systems. It's math executing at machine speed. In crypto, volatility isn't always emotional. Sometimes it's mechanical, and when leverage builds up too high, the market becomes a ticking time bomb. In market sentiment, what if I told you Bitcoin doesn't crash because of numbers? It crashes because of fear. Charts don't panic. Indicators don't get emotional. People do. And in crypto, emotions move billions. Fear, greed, FOMO, these aren't just buzzwords. They're the engine of the market. Unlike traditional markets, crypto never sleeps. Stocks close, banks close, but Bitcoin is always on. It trades 24/7 across Asia, Europe, America, nonstop. That means emotion never gets a cool down period. In traditional finance, institutional analysis dominates. In crypto, it's a different game entirely. A huge portion of the market is retail investors, and retail investors react emotionally. This creates both risk and opportunity. Fear, greed, FOMO, panic. This emotional volatility becomes price volatility. When people see red candles, they don't analyze. They react out of fear. This is the power of emotion. Let's be honest. When Bitcoin drops 5% in an hour, most people don't open long-term valuation models. They don't calculate adoption curves. They see red, and red triggers a psychological response. It feels like danger. It feels like loss. It feels like get out before it's too late. So instead of strategy, you get panic selling. Fear takes over, and you lock in your losses. Retail investors usually enter markets during hype. This often leads to panic selling at the worst time. Control your emotions to avoid these losses. They buy when prices are rising, when influencers are bullish, when headlines scream new all-time high. But when prices drop, they sell at the worst possible moment. This creates a powerful cycle. Price drops slightly, retail investors panic, they sell, selling pushes price lower, more panic spreads. It becomes self-fulfilling fear. A market falls not just because of fundamentals, but because people believe it will fall. Now, here's where it gets interesting. The market is poised for a major shift. This changes everything. In crypto, whales are large holders, individuals, funds, or institutions holding massive amounts of Bitcoin. When panic hits, whales don't always panic. They watch liquidity, they watch order books, they watch emotional weakness. And sometimes they buy during fear, while retail investors sell at a loss. Whales accumulate at discounts. This transfer of coins from weak hands to strong hands happens again and again in every major correction. Fear spreads instantly across time zones. Because Bitcoin is global, fear spreads like wildfire. A sell-off in the US triggers reactions in Europe, which triggers panic in Asia. Social media accelerates everything. Twitter threads, YouTube crash videos, Telegram rumors, it all moves at warp speed. In minutes, millions of people see the same red chart, and emotion becomes synchronized worldwide. In a 24/7 market, there is no pause button. The markets move relentlessly without pause. You must adapt. At its core, Bitcoin isn't just a technological asset, it's a psychological battlefield. If you understand charts but not human behavior, you'll always be late. Because in crypto, price follows emotion, and emotion spreads faster than logic. Macro pressure. Bitcoin doesn't exist in a vacuum. External forces create volatility. We must analyze the whole landscape. When interest rates rise, when global markets fall, when economic uncertainty increases, risk assets suffer. And Bitcoin is still considered a high-risk asset. When traditional markets shake, crypto usually shakes harder. Why exchanges freeze? Now here's the part most people don't understand. When price crashes, traffic explodes. Millions of users log in at the same time, trying to sell or withdraw. Even major exchanges like Coinbase and Binance have experienced outages during extreme volatility. So what actually happens? Server overload is a real risk. Exchanges are centralized companies. They run on servers. If too many requests hit the system at once, buy, sell, withdraw, the system slows down or crashes. It's like everyone trying to exit a stadium through one door. The door doesn't get bigger, the crowd gets stuck. Liquidity stress. Here's something critical. When you see Bitcoin in your exchange account, you don't actually control it. The exchange controls it. They manage pools of liquidity. If too many users request withdrawals at the same time, exchanges may temporarily pause withdrawals to manage liquidity flow. That doesn't automatically mean fraud, but it does mean you are dependent on their system. Risk controls. Sometimes exchanges halt trading to prevent extreme volatility. They may say it's for system maintenance or market stability, but the reality is, during extreme moves, platforms protect themselves first, because if they collapse, everyone loses access. The custody problem. Bitcoin was created by Satoshi Nakamoto after the 2008 financial crisis. The original idea was simple: no banks, no middlemen, peer-to-peer control. But today, we take back control. As people store Bitcoin on centralized exchanges, that means you don't hold the private keys, the exchange does. And in crypto, there's a famous rule: not your keys, not your coins. If an exchange freezes withdrawals, your Bitcoin is effectively locked. Yet you can't move it. That's counterparty risk. And it's one of the biggest risks in crypto. What this really means, so is Bitcoin dead? History says no. Bitcoin has died hundreds of times according to headlines. But here's the deeper lesson. Volatility exposes weaknesses. Weak risk management gets wiped out. Over-leveraged traders disappear. Poor custody practices get punished, and informed investors survive. Crashes are brutal, but they are also reset mechanisms. They flush excess speculation out of the system. Bitcoin crashing isn't new. Exchanges freezing during panic isn't new. What matters is understanding the system before you trust it. Ask yourself, do you understand leverage? Do you understand custody? Do you understand liquidity risk? Because crypto is not just about price going up, it's about structure, and structure determines survival in this market. Knowledge isn't optional, it's protection. If you want more real breakdowns, no hype, no fear, subscribe to Finance with Shahrukh. Because when markets crash, the informed don't panic, they prepare.